Hi, my name is Chris Rudden, leader of the investment consultant team at MoneyFarm. Welcome to the latest of our regular market updates. Please remember to subscribe to the YouTube channel and click the bell for notifications if you want to keep up to date with our content. As we reach the halfway point in 2021, now is a good time to take stock. The first 6 months of the year have confirmed the expectations we had at the beginning. It has ultimately been a year of recovery, which has rewarded investors that held firm and put faith in the long-term financial recovery. Global equity markets have performed positively, particularly those that missed out on the bulk of the recovery we saw in 2020. In particular, European equities outperformed their US counterparts, and we saw a significant rotation towards value stocks. This is a trend we've talked about at length since last year, and something that's played a significant part in our recent rebalancing. We're still in an uncertain economic situation, even after a period of recovery. As a result, the strong performance of these equities has raised some questions of its own. Equity valuations were already high 6 months ago, and they remain relatively high, even if they are still relatively cheap compared to their other asset classes. Whether value stocks will continue to outperform growth stocks remains unclear, and signs that the trend has reversed have started to appear over the last month or so. Having said that, the current market economic situation continues to give us confidence that our exposure to value stocks will be positive. From a historical perspective, the price differential between value and growth stocks is substantial. This is something that we expect to benefit from. Equity was the primary factor driving both the risk and return of our portfolios. In June, MoneyFarm's portfolios were positive thanks to almost all asset classes, with the exception of inflation-linked bonds and gold. A similar trend can be found in the bond market, specifically in the trajectory of long-term American yields. Looking at the 10-year US Treasury rate, we can see it grow from around 0.9% at the beginning of 2021 to 1.7% at the end of the first quarter. It then settles at around 1.5% in the second quarter. In situations of radical monetary policy, like the one that we're in, bond valuations can tend to dance to the tune of central banks. So, with that in mind, the sentiments that came out of the Fed meeting a few weeks ago are important. The key takeaways from the meeting are that interest rate hikes may come sooner than expected, while growth and inflation prospects have been reversed upwards. The Fed argues that the spike in inflation is largely driven by short-term factors, like fuel costs and production bottlenecks. It expects these pressures to be temporary and to probably be reabsorbed before too long. In our view, any announcement about interest rates are unlikely to be particularly aggressive. For the moment, the Fed is doing a good job of managing expectations and encouraging investors to look to the future and prepare them well in advance for any gradual changes in monetary policy. If the central bank's forecasts are confirmed, we don't see the stock market being particularly affected. Having said that, the potential removal of quantitative easing over the coming months might be something for us to keep an eye on. For investors, the most important thing is to have sound financial planning. To make it as easy as possible, our team is available to all customers. We can offer a detailed financial assessment of your financial situation and help you draw out long-term investment strategies. There'll be a link in the description for you to book a call. Thanks for watching. We'll be back in 2 weeks for more talking points from the financial markets.